Hey guys, it's Matt. So today what I wanted to do was spend some time talking about the differences and the similarities between mutual funds, index funds, and exchange traded funds. Over the holidays, I've been watching quite a bit of CNBC, and what I'm quite frequently seeing is these terms being used interchangeably. So I thought it may be useful to just do a quick video in terms of outlining what the similarities and differences are. Before we get too far into it, this is a personal finance channel focused on helping you make smarter financial choices. So if that is of something of interest to you, definitely subscribe to the channel. Also ring the notification bell. Ringing the notification bell will basically keep you informed when I release new videos. So without further ado, let's get into it. So let's start with mutual funds. Okay, so mutual funds is by far the biggest of the three of them. One of the reasons why the mutual funds is the largest of the three of them is because it's also the original one. Okay, it's been around for the longest time, right? So because of that, it's one of the biggest ones. The other reason why it's also one of the biggest ones is because if you think about your 401k as an example, assuming you're at a company that provides for a 401k and an employer match, and if you want to know more about 401ks, I do have a separate video on it, and I'll include a link for that up above. But when it comes to those 401ks, what effectively happens is the money that is being contributed is actually going to a mutual fund. That's why mutual funds are so much larger than some of the other ones as well. So the simplest way to think about a mutual fund is that these funds basically revolve around an investment thesis. Okay, so the investment thesis is something which the fund managers basically came up with. You'll say that, okay, I want to develop a mutual fund that follows X or Y or Z. Okay, I'm just going to have a mutual fund that focuses on a particular type of bonds or a particular type of equities or a particular type of foreign currency. It's basically like a basket that they essentially create. And then what these fund managers essentially do is, as individuals, right, contribute into that particular mutual fund, they actively manage those funds. They will make determinations in terms of what is actually included into that portfolio to help contribute towards that investment thesis. What they'll do is, if you're thinking about equities as an example, they'll say that, oh, okay, this particular equity that I have in this fund is not necessarily following the investment thesis that we have effectively communicated and come up with. Therefore, we're going to go ahead and take this particular equity out and replace it with something else or keep it out or whatever, right? But they will actively be managing the fund. While that sounds like a great thing, right? And I know several people that are a big proponent of mutual funds over the other ones, inclusive of Dave Ramsey as an example. Mutual funds, that level of active management, it does create some issues as well. When you have somebody, right, somebody who's actively managing the fund and are actually doing all this investment thesis and determining which stocks or which bonds or whichever underlying asset it is, they're actively managing it. So when you hear that word active management, what it basically means is it's going to cost you. Okay, so mutual funds typically have the highest costs associated with all three of these vehicles: index funds, exchange traded funds, and mutual funds. It can range from 1% to 2%. It doesn't sound like a lot, right? But over time, and of course, depending on how much you have in these mutual funds, these things, this 1-2% type of thing, can amount to hundreds of thousands of dollars, if you will, okay, over the course of 30, 40 years or whatever. And that's the biggest detractor when it comes to mutual funds. Outside of that, they're a great vehicle, okay? They provide for diversification, they provide for liquidity, they allow you to invest in things that you may not readily have access to, such as if you wanted to invest in some kind of a foreign type of instrument, right? It makes it easier to invest in it as long as you can find the particular fund that promotes that particular investment thesis, right? So it's got a lot of benefits when it comes to things like that, and that's why mutual funds is really a good investment vehicle, but probably not the most preferred investment vehicle in my view, but we'll talk about that in a second. The next investment vehicle is index funds. So index funds were basically created by this guy, Jack Bogle, who was also the founder of Vanguard. And what he basically wanted to do was find a vehicle or develop a vehicle, these index funds, right, that basically takes away from some of that fee component that we talked about for mutual funds. So he developed this vehicle where you have an index, okay, and it doesn't require as much active management as you would have with the mutual fund. So what it'll do is it'll basically just track an index. So you may have, for example, right, the most common one is the S&P 500. And if you're a Vanguard investor, you're very familiar with the ticker symbol, it's VFIAX. So what it basically says is, okay, this fund is essentially going to follow the S&P 500. It invests in those stocks, and whenever the S&P 500 moves up or down, this fund basically moves up and down in parallel with it. But when you have something like that, right, it's taking away from some of the thought process associated with active management. And due to that, the investment fees for index funds are substantially lower. Okay, they can be you can have 1% to 2% on mutual funds. On index funds, you could have 0.04%. So basically nothing, right? And over time, as we talked about in mutual funds, right, when you have those costs that could amount like hundreds of thousands of dollars, in the case of index funds over time, that could be in the hundreds of dollars, okay, or maybe like the thousands of dollars as opposed to the tens of thousands of dollars. So these differences between index funds and mutual funds as it relates to that active management portfolio perspective is significant, and the main reason why people go towards index funds. One of the other reasons why people go towards index funds is there's been a ton of research that basically shows that when it comes to something like the S&P 500, it's basically hard to beat, okay? I know Warren Buffett has put some money out there that basically says that, hey, you can find a hedge fund manager or whatever that can essentially beat the S&P 500 over a 10-year period. As an example, he'll give them X amount of money, and that's proven to be not the case because the S&P 500 is always kind of like beating these hedge fund guys and these guys who are charging all these monumental fees, if you will. So that's one of the big reasons for the index funds and why they're getting so much popularity, right? And why, in my opinion at least, they're a significant best investment choice amongst these three vehicles. The other thing just you should know about index funds, right? It does have a little lesser liquidity, right, than the exchange traded funds, which we'll talk about in a second here. Because what it basically says is that when you settle, so say you want to sell your index fund for whatever reason, it'll basically settle at the end of the day. It's not like an active stock, if you will, right, which you can just trade or settle like any minute, right? I'm just, I want to sell this now, I want to sell this now, I want to buy this or whatever, and you just kind of like keep buying and selling like during the course of the day. That level of flexibility does not exist with an index fund. It's not a big deal, right? But so I know some people like flexibility. In my view, that's actually a deterrent. When it comes to investing, for all intents and purposes, I feel like it's more important to keep your money in there for an extended period of time, such that you're not making any rash choice. And that's what you get with an exchange-traded fund, but you don't necessarily get that with an index fund. So let's talk about exchange-traded funds quickly. The big thing with exchange-traded funds is they're traded throughout the day, and you can buy and sell out of them at the drop of a hat. So they have, there's no such thing like investment fees and management fees and this and that type of fees and all of that, because it's basically like you're trading a stock. So they have the most liquidity, if you will, right? You can get in, get out, and that is one of the biggest differences between exchange-traded funds and the other two vehicles that we just talked about. So that's really it, right? So, I mean, if it were to me, right, I would rank them index funds by far the best, largely due to those professional fees and the fact that you can't necessarily beat the S&P 500, or it's very difficult to do so. And then after that, I would put like mutual funds as well as ETFs, right? Because the mutual funds, ETFs, they have like pros and cons, right? It just depends on what it is that you are trying to accomplish, really. With mutual funds, it's easier because you have like professionals who are effectively managing it for you. It's creating a lot of diversification, and that's the game that you're effectively playing, right? With ETFs, you're kind of like making some of these choices on your own, and you'll pick like something that you want to effectively invest in. And you have to do the legwork and try to figure out, what is the most optimal ETF for you. So anyway, I wouldn't put one against the other, right? All three of them are all very useful vehicles. It just depends on who you are from an investor perspective, right? And what is it, some of the goals and things like that you want to accomplish. But it's important that you understand the costs, right, associated with all three of these and some of the pros and cons. So that's it. That's all I wanted to cover up on this video. Just a reminder in terms of what the differences are between mutual funds, exchange funds, and index funds. If you have any other thoughts associated with any of these, definitely include it in the comments below, and I will see you soon.